Today's question comes from James in Wyoming. He says, I'm 28 years old. I'm looking ahead to baby step 4, where my fiance and I will invest 15% of our income into retirement. What are your thoughts on dividend investing? I was thinking after the house is paid off, the only thing better than no payments is having passive income from our investments covering our living expenses. I want to achieve this before the age of 60, when we can start withdrawing from our retirement.
Imagine having $40,000 deposited into your bank account every year without having to work at all. Well, that dream technically could become a reality through dividend investing, which is why so many people love the idea of buying dividend stocks. But it's not that simple. If you had to choose between investing $10 million and receiving $40,000 in dividends, or investing $100,000 and receiving $40,000 in dividends, which option would you choose? Obviously, the $100,000 option. And so the question this guest is asking is a bad question, because he's just thinking about passive income, not how much money it takes to make that passive income. A better question would be, how do I maximize my passive income with the money I have? And so in this video, I'm going to answer that question better than Dave Ramsey answered it. If you want to check out Dave's response to this guest's question, I linked the video in my description. But in this video, I'm going to tell you how dividends aren't the only way to generate passive income in the stock market, when dividend companies outperform the market, and how to maximize your passive income. Let's dive in. But to understand how to maximize our passive income, we first have to understand how dividend companies work. To understand this, we have to understand a company's life cycle. Companies that are new and still growing rely on new money flowing into the business to help it grow. They do this in the form of selling shares of their company to the open market or taking on debt. Because these companies are still younger, they're often riskier, and you'll see the price of their stock fluctuate more. Examples of these companies are Airbnb, Uber, and Coinbase. As the company matures and generates more of a consistent profit, they'll be able to self-fund their growth through reinvesting profits back into their business. These stocks are safer than the previous ones because they've shown the ability to generate a consistent profit. Examples of these kinds of companies are Google, Facebook, and Netflix. Once a company has reached the peak of their growth, they realize that continuing to invest profits back into their company will produce diminishing returns. So they will elect to pay a portion of profits as a dividend to their investors. Examples of this are Coca-Cola, Home Depot, and Verizon. Now that we understand how dividend companies work, there's another question we have to ask. Are dividends the only way to achieve passive income in the stock market? Well, when you receive a dividend payment, you're directly receiving a portion of the profits from the company into your account without having to lift a finger. It's truly passive income. But you don't have to own a dividend company to earn passive income in the stock market. Let me show you how. In this video, Dave gave the example of General Motors as a dividend-paying company. In 2017, General Motors gave investors a 17.65% return. They also paid a dividend of 4.05%. So if you invested $100 into General Motors, your investment would have grown to a little over $117, and you would have received a $4.50 dividend into your account. In that same year, Google, a growth stock that doesn't pay a dividend, gave investors a return of 32.93%. So if you invested $100, it would have grown to a little over $132, and you wouldn't have received a dividend payment. But because of this excess return in the Google stock, you could have sold some of your shares until your stock position was worth a little over $117, putting you in the same position as if you invested in General Motors, and deposited $15.28 into your account from the sale of the stock. This, in effect, would be the same as the company paying you a dividend. But in this case, the payment you gave yourself by selling off some Google stock would be more than 3 times the dividend that General Motors paid. So in this year, you would have generated more passive income by buying Google stock and selling the excess return instead of buying General Motors and receiving a dividend. So you can own any stock, and as long as it gives you a positive return, you can sell the profits and pay yourself a dividend. But obviously I picked 2 random stocks in 1 year, so this isn't a sustainable example. Clearly, there are some years when General Motors would have done better than Google stock, and some years where both stocks would have produced negative returns. So to answer the question, how can we maximize our passive income through investing in the stock market, we have to understand when dividend stocks outperform growth stocks and vice versa. So when do dividend stocks outperform growth stocks? Well, oftentimes because dividend stocks are more mature and less risky, it also means there's less upside. On the other hand, growth stocks are not as mature and more risky, which means even though there's more downside, there's also more upside. So in general, when the economy is growing and expanding, you'll see growth stocks do better than dividend stocks because the growth stocks have more upside. And when the economy is slowed down and it's not as strong, you'll see companies that are more mature and less affected by the downturn in the economy do better because they have less downside. For example, from 2008 to 2012, when GDP grew an average of 0.81% per year, we saw dividend stocks get an average return of 9.84% per year, while in that same time period, growth stocks got a return of 6.78%. And then from 2017 to 2021, when the economy grew at 2.13%, we saw dividend stocks get an average return of 16.33%, while growth stocks got an average return of 27.35%. So if we want to maximize our passive income, we have to be able to accurately predict what the economy will do. So how can we predict exactly what the economy will do to maximize our passive income? Well, unless you can find a crystal ball, you can't. And that's why investing only in dividend stocks for passive income is overrated. In order to maximize the passive income you can generate, it's important to hold a mix of both dividend stocks and growth stocks to be able to benefit from both a growing economy and a slowing economy. While there are many other factors that play into whether growth stocks or dividend stocks will outperform, I wanted to create a very general framework for why one could outperform the other. So when the economy is slower, you can rely on income from your dividend stocks. And when the economy is growing and your growth stocks are outperforming, you can sell off the excess returns to generate income for yourself. Even more specifically, at 28 years old, the best way to maximize your passive income is to keep your money invested without selling it for as long as possible. And that includes reinvesting the dividends you do earn along the way. The only time you should start taking passive income from your investments is when you're ready for your investments to stop growing. While learning what to invest in is extremely important, there's something I didn't cover which is just as important when it comes to maximizing your passive income, and that's choosing where to invest your money. And that's why I created this video detailing exactly how I would save and invest my money if I started from zero. So check out this video next if you want to learn the step-by-step process for creating and maximizing your passive income.